Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and today's date is January 6th, 2024, and our model portfolio is up 0% because we took no positions last week. So here at Spy Trader Now, what we do is we trade the S&P 500 ETF symbol SPY. We do it with a very simple portfolio, 3-position portfolio, shares of SPY or options or in cash. Currently, the portfolio is 100% in cash. We start out each year, this is the beginning of the year in January, with $100,000, and we try to build from there. Last week, the S&P 500, as you can see, lost 1.55% so far. We do a stock market strength color signal, and I'll show you how we arrive at this later on in the presentation, but we currently have a green signal strength for the stock market. Here are some past returns in 2020 for the model portfolio. In 2023, we only did 14% up, and the market did 24%, incredibly impressive. But the past years prior to that, we had pretty good favorable returns. Last week, the S&P 500 lost 1.55%. We're going to be going through the charts in much greater detail later on in the presentation. Here you can see where we had nine strong weeks that were in green candles. Finally, we got a red candle to the downside. Also, you can see that if you carry this previous high lined straight across, we stopped right at about that line. So right now we're still in an upper trading range here. We'll see if we dip below that to drop into this next range to see if that holds support. Then if it falls below that, then the next area of support is going to be down here about 423. Last week we made no trade. And here are all the trades for 2024. There are none because we didn't make any yet. If you stay tuned if you want to see how we progress throughout the year, hit that subscribe button, ring that bell, and help me by smashing that like button down. Thank you. And here's our model portfolio equity curve for, oh shoot, that should say 2024. I'll correct that for next week's video. And you can see that we're flat because we just stayed in cash. Here is the equity curve for the S&P 500 buy and hold investor. They went down. And here is the two equity curves combined for the S&P 500 and the model portfolio. There's the Fed chair, Jerome Powell. The last announcement was made on December 13th, 2023, where they did a Fed skip rate hike. And the next announcement will be on January 31st. Are we going to have a 25 basis point rate hike or a skip? Keep in mind it's an election year. The closer we get to November, there's no way the Fed is going to make any changes. Now, the Fed did say that they were going to cut interest rates 3 times in 2024. They said that at the announcement that they made in December. So we'll see what happens here. Now we're looking at things from the presidential election cycle theory, which states depending upon the year of the election, you have historical rates of return. This is for the historical rates of returns for the S&P 500. This is the historical rates of returns for the NASDAQ 100. Now we are in the 4th year of President Biden's term. Historically, for the S&P, that has averaged 6.7% gain, and for the NASDAQ 100, 9.43% gain. Now, last week, the S&P 500 lost 1.55%, giving plenty of room for it to go to the upside between now and the end of the calendar year and be within the historical norm. Now we are looking at things from the bond market outlook. We still are in an inverted yield curve, meaning that the long-term 10-year Treasury rates are yielding a lower yield than the shorter-term 3-month and 2-year yields. This is backwards. This is inverted. It's supposed to be the other way around. This has been like this for some time now, and I'm expecting it to correct at some point in 2024. And then most times shortly after that reversion back to normal, 1 to 4 months after that is when the S&P 500 will take a good dive. So we have to monitor this to see when we go back to normal and then monitor what happens afterwards. Of course, we're looking at the S&P 500 every week anyways, but we're staying in tune with the bond market. But from the bond market's perspective, equity investing right now is risky. Now we are looking at things from a valuation standpoint. According to current market valuation, CMV, they're saying that we're overvalued. PE ratio 52.9. Historical 10-year average for the PE is 30, putting us above average here. So we're 52% above the average of 20. We're currently at 30.9. Sorry, I misread that earlier. And that puts us on a standard deviation chart at 1.3. So definitely risk in the market from a valuation standpoint. Now here's our friend Warren Buffett, the the sage of Omaha. So, but anyways, he's got his saying here about fear and greed. And CNN Fear and Greed Index, we were in extreme greed last week. We are right at the pushing edge here of greed. We're at 74, last week 75. So we're right there right now. So there's risk, the higher you come up here, the more risk there is in the market. Now we are looking at things from a seasonality outlook. This graph down here is the 20-year chart for the S&P 500 on a seasonality basis. Currently, we are in the month of January. 45% of the time in January, the month will close higher than when it opened. Poor odds compared to some of these other months, right? As a matter of fact, if you look at your seasonality basis across all 12 months, January is the worst month to have a probability of closing higher than when you opened the month. Currently, the month of January, we are down 1.55%. These are historical averages for the year for the S&P 500, so we'll see how this year plays out. Now we are looking at things from a long-term monthly 20-year chart of the S&P 500. Long bull run, correction, broke out, never look back. We're in a long-term bull market run still, as long as we stay above this line, and as long as the MACD is positive, which all of these things are happening, telling us that from a long-term outlook, we're definitely in a bull run still. Even with this pullback correction, we're still considered in a bull run. Now we're looking at things from an intermediate outlook. This is a 5-year chart, S&P 500 weekly candlesticks. Each bar represents 1 week's worth of data. You can see that we were trending up. We broke out above it. I kind of talked about this a couple of slides ago. So we're right here, but we're still at very high levels here for the S&P 500. No major pullback at all yet. Now we are looking at things from a short-term outlook. 6-month chart, daily candlesticks. You can see that upward trading pattern that we did. I put in a Fibonacci extension from the low to the high, and I'm expecting a pullback somewhere between the 38.2 and the 61.8. Somewhere in this window is the expected pullback. And where we stop and begin to go back up is going to determine the strength of the next move. If you stop here at the 38 and then pull up, that's strong. Come down to the 50 and then pull up, that's a little bit weaker than the 38. Come down here to the 61 and then pull up, that's a little bit weaker than if you had stopped at the 38 or the 50, to tell you the strength of the next move. You break the 61.8, come down here and then come up, then the odds favor that you're not going to break that high on the next move up. So that's how I'm looking at this, and we'll see how the market actually does as we follow it throughout the weeks. Now we are looking at a daily chart, and this chart, what I'm trying to display to you is how overvalued the MACD is on a daily chart. You're looking at 4 years worth of data here, but I actually did this going back 20 years worth of data. And the MACD has only been this high in 20 years where these red lines have intersect. This is where we are at right now. The last 2 times the red line, you saw an 8% correction here, and you saw a 16% correction here. This is where we are at right now with the MACD level at its its current valuation point. So we're at a very high level for the MACD, and we'll see how this plays out. But it looks like we're definitely going to have a reasonable correction, some place between 8% and 16%. Like I said, we'll see how this plays out. And then you can see the rest of the corrections here. Most of the times after you get such high levels, you do get a pullback. Like rarely, like here, the pullback took a long time and it was extremely shallow. So we'll see how this plays out. It's going to take a little bit of time for this to develop, for us to figure out what's going on. Now we are looking at a risk-on indicator. And we're comparing the NASDAQ 100 against the S&P 500. Now, we do have a negative divergence on this ratio chart, which I show you here on the MACD. You see the MACD made a lower high here, whereas on the ratio chart it made a higher high. And that's depicted by this red solid line right here and the arrows, so I can call it out to you. So right here, when we caught this last week, we knew that risk, we felt like we were hitting a resistance point and risk was coming down, which of course it did do. S&P 500 lost 1.55%. So right now though, on this ratio chart, you're hitting a point of support, meaning that for the next couple of weeks, I wouldn't be surprised if the NASDAQ 100 outperforms the S&P 500. We'll watch this and we'll see how it plays out. Now we're looking at another ratio chart, equal weighted S&P 500 compared to the normally weighted S&P 500. The ratio chart is in the black and red color. The equal weight is in green. Normally weighted S&P 500 symbol SPY is in the dark blue. You can see that the equally and normally weighted S&P 500 are right up here at the highs. The ratio chart fell off a cliff, which it's done 2 times in the past 20 years, well, 3 times including the most recent time in 2023. But the past 2 times you see the S&P and equally weighted also fall off of a cliff here and here. You did not see that. You saw a correction here, but nothing really significant. Not like it did the past 2 times prior to this. So it's this would definitely be considered a soft landing if this is all that there is to this market fall. We'll see if this soft landing turns out to be true or not. But so far it's holding up that it is true. Now we're looking at the VIX, Volatility Fear Index, and I call out 3 ranges here: the ultra low range, the low range, and then this upper range. You're going to lose money when you go from the ultra low range up to the upper range. And we are starting to travel in that direction like this. You can see a low, a high, a higher low, and now a higher high. Very, very subtle and very mild higher high, but still, these are higher highs here compared to here, even if you take the wicks. So it looks like the MACD on this, excuse me, the candlestick pattern on this is starting to trend in this direction. And the S&P 500 goes in the opposite direction, down. When the VIX goes up, the S&P 500 goes down. So the MACD is traveling that way, slow stochastics is traveling that way. So fear is definitely increasing in this market. Now we are looking at Thinkorswim's platform. This is a 5-year chart, S&P 500, and this is a weekly chart. And here you've got standard deviations, +2, -2 in gold, +1, -1 in pink, regression line dashed green. Currently we are at 0. We are right smack dab in the middle of all of these regression lines right now, meaning that this market can go in any direction. I've got some alerts that will automatically ping my cell phone depending upon what direction this market goes in. And I'm just keeping a very close eye on this. But from this chart, it can go in either direction. The slant of, or the slope of the standard deviation lines gives you easy, clear indication of overall trend. On a 5-year weekly basis, the trend is up. You can see that the support is at the -1 standard deviation line. In this case, it broke that, but in this case, it pretty much held it, and it's been holding it ever since October of 2021. Now we are looking at a 1-year chart for the daily chart for the S&P 500. Same thing with the standard deviations, but on this chart we are at 0.3 standard deviation. We almost hit the +1 and we started to correct back down. 68% of the time you are going to trade between the +1 and -1 standard deviations. As you can see, most of that is happening in this time frame. Now we are looking at a 6-month daily chart for the S&P 500. Notice the slope of the standard deviation line has changed to a little bit flatter. Still an upward slope, but a little bit flatter. I've put down in here your sell zone and down here at your buy zone. So if this thing does come down here and correct, we're going to take on some long positions, because right now it's buy the dip is the way I'm interpreting the S&P 500 from everything that I'm seeing. We do want to buy and go long the pullback, which is what we are getting right now, is the pullback. The only thing we don't know is how long and how deep it's going to go yet. We don't know that yet, so we have to watch it. But we know from this trading that happened here, we know that it's stuck in this range for a while, somewhere around 453 to 460. So somewhere in there it's going to stick. We'll see if it breaks through it, holds it, and then starts to advance. We'll see what happens once we hit this point. Now, this is my chart where we do the stock market strength, and we're based on asset classes and the 11 S&P 500 sectors. So you see the S&P 500 right here, and we broke this down further to the 11 sectors of the S&P 500. ETF symbols are all right here for your asset classes. Here we're just looking at all different types of asset classes, just to get us an idea of what the world is doing in the way of assets. Last week we were at 81% for the world's assets, and now we are at 77%. So the overall asset classes are coming down a little bit in strength. Interestingly enough, look at the S&P 500. Last week it was 87. This week it's at 95. And this is how I arrive at that information. It depends on the slope of the 50-day moving average, also the standard deviation lines, and whether we're trading below or above the 50-day moving average is how we derive at this information. And that gives us our color guard signal as well. We're green in both of these, but that's where we stand. Now we're looking at a 1-year chart of the 10-year bond yields. That's going to be the candlestick chart here, S&P 500 in dark blue. You can see that we've reached a level of support at 38 on this chart, and we're bouncing and starting to travel up. Interestingly enough, the last candlestick, that's called a doji, because it kind of has a long wick and a long tail and a small body, and it's right there in the middle, right there at that 200-day moving average for the 10-year treasuries. So doji candles represent indecision. We'll see what happens here, if there's going to be some indecision or if we continue to travel up. Okay, I've just given you a market summation. So this is January 6, 2024, the market summation according to me, Ken, your friendly host with SPY Trader Now. So we just started a new year and we have a new portfolio. As you know, the portfolio is 100% in cash because I see too much weakness right now to go long this market. We know the market is trending down and I don't want to take any market risk yet. So we're going to stay in cash for the time being, and we are going to watch the market action. That is it. I hope you stay with me. Hit that subscribe button, ring that bell, and do me a favor, smash that like button down for me right now. I thank you, and I wish you good trading.